The 1929 Wall Street crash. In October 1929, the Wall Street stock market crashed. The real damage came from what happened next, a complete collapse in financial confidence that spread worldwide. When the stock market crashed, investors panicked and banks started failing. When banks fail, credit disappears. Businesses need credit to operate and pay employees. Consumers need credit to purchase homes and cars. Without it, economic activity freezes. The situation became worse in 1930, when the United States passed the Smoot-Hawley Tariff Act, imposing steep tariffs on imported goods. Other countries retaliated immediately with their own tariffs. This tariff war caused international trade to plummet by over 50%. The economic damage was massive. Between 1929 and 1932, worldwide GDP fell by 15%. In the United States, real GDP declined by 30%. Unemployment reached approximately 25%. The recession happened because the stock market crash destroyed confidence, causing spending and investment to drop sharply, while tariff policies strangled international trade. The 1973 to 1975 oil shock. In October 1973, Arab oil-producing countries imposed an embargo on the United States in response to American support for Israel during the Yom Kippur War. Crude oil prices nearly quadrupled almost overnight, jumping from approximately $3 per barrel to over $11 by January 1974. Oil is fundamental to modern economies. It powers transportation, manufacturing, electricity generation, and heating. When oil prices quadruple suddenly, the cost of producing almost everything increases. These costs get passed through the entire economy. The price shock fed directly into inflation worldwide. Prices climbed rapidly while economic growth stopped. Economists call this stagflation, stagnant growth combined with high inflation. Stock markets dropped sharply, consumer spending fell, businesses cut back on investment and hiring. In the United States, approximately 2.3 million jobs disappeared and unemployment reached 9%. Europe and Japan experienced similar slowdowns. What made this recession unexpected was its trigger, a deliberate political action using oil as a geopolitical weapon. The global economy's dependence on Middle Eastern oil became suddenly obvious. The 1979 to 1980 second oil shock. In 1979, Iran experienced a revolution that caused oil production to collapse. Strikes and upheaval cut Iran's output by approximately 4.8 million barrels per day, roughly 7% of the world's total supply. Oil prices doubled between 1979 and 1980, reigniting inflation problems worldwide. Central banks, particularly the US Federal Reserve, decided to take aggressive action. To fight inflation, they sharply raised interest rates, making borrowing more expensive. The Federal Reserve pushed rates dramatically higher to cool the overheating economy. These rate increases worked to control inflation, but came with severe costs. Higher interest rates meant businesses couldn't afford to borrow for expansion. Consumers couldn't afford mortgages or car loans. The economy tipped into a deep recession. Unemployment in the United States eventually reached 10 to 11% by 1982. This recession demonstrates how oil shocks create impossible policy dilemmas. When oil prices spike, inflation rises. Fighting that inflation with higher interest rates causes unemployment and economic contraction. Most countries chose recession, believing uncontrolled inflation would cause worse long-term damage. The 1980 to 1982, early 80s global recession. The early 1980s recession was the aftershock of previous oil crises. The devastating blow came from aggressive policy responses meant to fix inflation. The Federal Reserve implemented dramatic interest rate increases, pushing the federal funds rate above 20% by 1981. This was shock therapy for an economy with double-digit inflation. High interest rates make borrowing expensive. Businesses stop expanding, stop hiring, stop investing. Consumers stop buying houses because mortgage rates become unaffordable. The entire economy slows by design. Major industrial countries experienced double-dip recessions, where economies contracted, recovered slightly, then contracted again. The World Bank declared 1982 a global recession. Canada's GDP fell approximately 5% in 1982, with unemployment reaching 12%. The United States and Europe saw similar damage. This recession was unusual because it was deliberately induced. Policymakers chose economic pain as the cure for inflation. They calculated that deep recession causing widespread unemployment was preferable to spiraling inflation. The gamble worked. Inflation came down, but millions lost jobs and entire industries were devastated. The 1990 to 1991 Gulf War oil shock. In August 1990, Iraq invaded Kuwait. This removed major oil production from global markets. Crude oil prices jumped from approximately $17 per barrel to around $36. This was the third major oil price shock in less than 20 years. Higher oil prices mean higher inflation. Higher inflation means central banks raise interest rates. Higher interest rates mean economic slowdown. Added uncertainty came from active warfare in a region producing huge portions of the world's oil. Investors fled to safe havens like gold and the US dollar. Stock markets became volatile. Global trade stalled as businesses and consumers waited to see how the conflict would unfold. US monetary policy was already tight before the invasion. The oil price shock on top pushed the economy into recession. The recession ended quickly once the Gulf War concluded in early 1991. Oil prices dropped after coalition forces pushed Iraqi forces out of Kuwait. Unlike previous oil shocks lasting years, this one proved short-lived because the military conflict was resolved within months. The 1997 to 1998 Asian financial crisis. On July 2, 1997, Thailand floated its currency after spending months defending it against speculative attacks. When Thailand let the baht float, it immediately lost significant value. The crisis spread across East and Southeast Asia through financial contagion. Investors questioned whether other Asian currencies were overvalued and began pulling money out of Indonesia, South Korea, Malaysia, and the Philippines. Currency collapses triggered devastation. When currencies lose value rapidly, foreign currency debts become much more expensive to repay. Many Asian companies had borrowed heavily in US dollars. As local currencies crashed, their dollar debts effectively multiplied. Companies that seemed healthy suddenly couldn't meet obligations. Equity markets crashed. Credit markets froze because banks didn't know which borrowers would survive. Indonesia's GDP plunged approximately 13% in 1998. South Korea's economy shrank about 6%. Thousands of companies went bankrupt. Major banks failed. The crisis had spillovers beyond Asia. These countries were major trading partners globally. When their economies collapsed, they stopped importing goods, hurting exporters worldwide. The 2001 dot-com and September 11th recession. The late 1990s saw an enormous speculative bubble in internet stocks. Investors poured money into any company with .com in its name, often without regard to viable business models. In March 2000, the bubble burst. The Nasdaq crashed. Trillions in market value evaporated. Companies valued at billions went bankrupt. Technology companies laid off thousands. Then came September 11th, 2001. Terrorist attacks created a massive shock to confidence. People stopped flying, traveling, and spending beyond necessities. Businesses postponed investment decisions because the future seemed uncertain. The combined effect pushed the US and other major economies into recession. US unemployment jumped from approximately 4.2% in early 2001 to 5.7% by year's end. GDP growth turned negative, shrinking about 1.3% in the third quarter. This recession had dual triggers from completely different sources. The dot-com crash was a classic financial bubble bursting. The September 11th attacks were an external geopolitical shock nobody had predicted. Together, they created conditions that knocked confidence and derailed economic growth globally. The 2008 to 2009 global financial crisis. The US housing market boomed for years before 2008. Lenders made mortgages available to almost anyone, including people with poor credit. These subprime mortgages were packaged into complex securities and sold to investors worldwide. The system worked while housing prices rose, but in 2006 and 2007, prices started falling. Borrowers couldn't refinance, defaults skyrocketed, the mortgage-backed securities lost value. Banks worldwide held trillions in these securities. Nobody knew which institutions were holding worthless paper. Trust evaporated. In September 2008, Lehman Brothers collapsed. Other major institutions failed or required bailouts. Credit markets seized completely. Banks stopped lending because they didn't trust repayment. Without credit, businesses couldn't operate. The downturn synchronized globally. US GDP fell approximately 4.3%. Unemployment hit 10%. Trade collapsed worldwide. Industrial output plummeted. By 2009, world growth turned negative for the first time since World War II. The crisis demonstrated how interconnected modern economies had become. A housing bubble in America triggered bank failures in Europe, factory closures in Asia, and recessions everywhere. The 2010 to 2012 European sovereign debt crisis. In 2010, the world discovered Greece had been hiding its true government debt. Greece had used accounting tricks for years to make finances look healthier. When truth emerged, it revealed Greece had borrowed far more than it could repay. Investors who had lent money to Greece worried they wouldn't get paid back. Bond yields spiked dramatically. Higher yields meant Greece paid much more to borrow, making its debt problem worse. The crisis didn't stay contained. Investors examined other European countries with high debt. Ireland, Portugal, and Spain came under scrutiny. A deeper fear emerged. The Eurozone itself might break apart. Markets plunged as investors fled to safe assets. Growth forecasts were slashed globally. The Eurozone slipped into recession in 2012. GDP fell. Unemployment surged. Spain's unemployment reached approximately 25%. Greece suffered worse, with youth unemployment exceeding 50%. The crisis required massive bailout programs from the European Union and International Monetary Fund. The economic pain dampened global growth throughout 2011 and 2012. The 2020 COVID-19 pandemic. In early 2020, a novel coronavirus spread rapidly worldwide. To slow the spread and prevent healthcare system collapse, governments implemented lockdowns. This was a simultaneous supply and demand crisis. Factories shut down. Supply chains broke. Workers couldn't go to work. Production stopped. Consumers couldn't spend. Restaurants closed. Shops shuttered. Travel became impossible. Every major economy fell into recession simultaneously. The IMF projected global GDP would contract approximately 3%. Advanced economies were expected to shrink 6.1%. Unemployment spiked worldwide. In the United States, unemployment briefly hit 14.7% as businesses laid off millions overnight. Service industries were devastated. Some businesses never reopened. The IMF called it the worst downturn since the 1930s. What made this unusual was its cause. Previous recessions resulted from financial problems or policy mistakes. This came from a public health emergency. The lockdowns causing the recession were the primary tool governments used to fight the pandemic. Governments responded with unprecedented stimulus, but couldn't prevent the sharpest economic contraction in modern peacetime history.